There's an article in Newsweek that says there's a lot of things in retirement that you can do on your own. But the one thing that you should not do on your own is taxes. A do it yourself approach to taxes can be a little bit on the dangerous side. They bring up a number of different things here, but the last one is the IRS is watching you. So if you make a mistake, they're ready to pounce. So why is it that people get over their skis when it comes to taxes?
Well, I think with all the legal Zoom and TurboTax and all the online things, they've really simplified how to do taxes. So the actual application of doing tax returns, I think people think, well, I can do that on my own. That's not tax planning, right? That's tax prep. You're doing the year's over. There's no planning to do.
Mm-hmm.
Like that is
Yeah.
super baked. You're plugging a bunch of numbers in and paying whatever's paid. So when we talk about tax planning, we're talking about proactive things that you're doing to minimize tax exposure. You're trying to save money in taxes. And I think why this gets missed a lot is because it's not fun to talk about. Not a lot of people, financial advisors, accountants, aren't really in the business of going out there and trying to help people save money in taxes. And because of that, it doesn't have a lot of discussion points. You don't hear a lot of talking about it. So for us, when we sit down and really break down how to win in taxes, we have an internal team of CPAs that builds a tax map, and everyone knows that their largest taxable, the biggest area I can make an impact on tax. I know everyone has a story. The reality is there's not a lot of opportunities to consume whatever after-tax dollars you take and have tax benefit. And let me put that another way. You really can't do that much tax planning if you're going to spend it. You can give money away. There's charitable gifting, there's generational gifting where you're putting money away and never spending it. There's ways you can save money doing that. But if you plan on using your money, your window of doing tax planning is very small. Don't let anybody lie to you. There's very few things that you can do to save money from a tax perspective when it comes to money that you actually need to spend in your lifetime. And one of the main things you can do is make your IRA tax, obviously, exposure very efficient. And people don't realize this. Their IRA, their 401k, whatever you want to call it, 403b, Ohio Deferred Comp. This is their biggest taxable asset. So this is your biggest opportunity to save money in taxes. And most people do the opposite. They don't plan at all, Randy. It's not even a DIYer. It's a do it laterer. It's a
Okay.
DIL, or I'll do it
Later.
later. I'm going to do it later. And it's because the industry has told us, our advisor has told us, hey, you can just wait till 73. Don't pay tax on it. And then, at some level, you have to be like, well, wait a second, I'm retired. Income tax rates are super low. Why would I kick the can on this? That's a question you should be asking, because if you wait later, Uncle Sam wins. Because if a spouse dies, you run into the widow's penalty, where you're going to pay double interest rates because you go from a couple to a single filing tax, payer, or it goes to your kids who are at their highest earning rates. People don't realize your kids pay tax on your IRA at their rates, not yours, which can be even more consequential. So if you have a $500,000 IRA and you're paying, you could get it out. If you had a tax map, a tax plan with Golden Reserve, you could theoretically get that out at 10%. So you end up paying 50 grand. We get it out over 10 years. Right when you get retired, we utilize your lower tax rates. But if you wait and run into the widow's penalty and don't take anything out till 73 and you have an unexpected death of a loved one, well, guess what? It could double. So you can end up paying 100,000. Or even worse, it goes to your kids who pay 40% tax. They can end up paying, 200,000. So of your $500,000 IRA, you could pay almost half to Uncle Sam if you don't do the right planning. So that's why every, plan that we build, every roadmap we sit down with, Randy, we start with the tax map, because it's the easiest, lowest hanging fruit where we can actually be proactive and beat Uncle Sam in a way that's very predictable and easy.